I introduce our speaker for today, who is a very distinguished one, Mr. Abhishek Gupta, who has around 2 decades of work experience. Just for his credentials, he is a CFA charter holder and he has completed his MBA from IIM Calcutta. He manages two funds for us. One is the HSBC Flexi Cap Fund, and another one is HSBC ELSS Tax Saver Fund, with a combined AUM of around 9,000 crores. And that's not no less than a feat. He has worked in the past with both domestic and international fund houses. These are very distinguished and eminent credentials. And with this, I hand over the floor to Abhishek, who can take us over the outlook, the investment philosophy, and fund strategy. Over to you, Abhishek.
Thanks, Ashish, for such an introduction. I must say, I feel rather great to hear that kind of an introduction. But clearly, I think, and yeah, for everyone else out here, welcome and good evening to all. I think the purpose which I'm trying to get done with this webinar is we're trying to kind of answer those questions which are very pertinent and raised by Ashish. So let me just kind of take you through for the what I want to do. I want to split this discussion or this conversation in two parts. First, we will try to talk about what we are looking at a more top-down view when it comes to the market conditions. What are we looking in terms of what's happening around? How has the market been behaving? And then we'll dive into specifics of the fund, where I'll also take you through the philosophy and the investment style which we follow. And in the end, I like to keep about 15-20 minutes buffer for all of us to have interactive session. So whatever queries you have, feel free to post to the best of my ability. I like to answer them. So with that, let's get started. It's always a good idea to start first with the introduction and the recap rather. So let's just see what has happened in the recent past. Just give me a minute. Okay, so just kind of reflecting back what we saw in April 2024, which is the month went by, you can clearly see that the kind of momentum which market has been building for now over 12 months, it's been kind of continuing to the fact that the Nifty had three back-to-back months of positive performance and it delivered almost 1.2% performance in the month of April. Mind you, this performance has not come without volatility. So if you look at the Nifty at an overall level, it has seen a swing factor of anywhere between 1,000 odd points and finally gaining 278 points to close higher. So clearly it kind of highlights the amount of volatile times, amount of uncertain times we are living in. Just kind of reflecting back, so just kind of thinking through what would have helped, what would have contributed to this performance. On your right, if you look, this is more the data which has kind of been accumulated for CY24 YTD since January. Clearly, I think it's not an aberration, or rather, we would have guessed it if you look at the performance which has come so far. PSU banks, real estate, utilities, power, automobile, oil and gas. So predominantly capex heavy, predominantly traditional manufacturing spaces have done pretty well in this time period. On the contrary, with again uncertainty, which Ashish also talked about in the initial remarks, with what's going to happen in US as a geography, we still are kind of going through uncertain time when it comes to the growth visibility across the globe, more on the developed nations. So with that in the background, there has been some amount of uncertainty or underperformance by technology broadly as a space. Also, the fact that we have had 2 years where rainfall has been a little patchy. We have seen inflation taking its toll. There has been kind of a K-shaped recovery where the bottom of the pyramid has not been consuming well. Also, the staples sector, which is predominantly consumer, whether it's staples or QSR, has underperformed. So that has been broadly the color of the market, which we have seen CY24 so far. If I kind of move ahead, so clearly we now have a background set, what market did. I also want to take you to this thought where a lot of people get worried about the fact that Indian market has done so well. Is it become very expensive? How do we fare versus global market? Because clearly, what kind of money is kind of coming in from FI and the foreign investors is something which is on the mind of Indian investor always. So some data in front of you in regard for that. So last 12 months, if you look, clearly there is a strong performance which has been driven by MSI India versus MSI emerging market, almost a 25% outperformance on last 1 year basis. If I look at 10-year data, this is when it gets staggering, right? If you look at the data on the top right side of the chart, we are looking at 10-year data where you can see that over a cumulative period of 10 years on a CAGR basis, which is annualized return, MSCI India has delivered 12.3%, and these are all dollar-based returns, so not even taking the benefit of currency here. But if you look at MSCI Emerging Market as an overall index, it has barely given you even 1% return, so 0.5% to be precise. Similarly, you cut through the chase to last 5 years, even then the MSCI India performance looks stark. It's delivered you almost touching 15% return, 5-year CAGR basis, while MSCI Emerging Market during that point of time has given you negative return. If you just focus on the first two aspects of the data, I'm sure you will feel that now Indian market has become very expensive. The outperformance is clearly in front of us. That's when the most important point, which is the bottom chart, comes into play. This is where I'm trying to highlight to you that yes, Indian market has performed, it has given you absolute return, but return is just one part of the equation, right? That's the numerator part of it. What one has to even focus on is on the denominator side of the aspect, which is the earnings. The growth, the performance which comes backed by earning is always a more sustainable and something which is more sticky in nature. A data I'm trying to prove it here is if you look at emerging market, how India has fared versus emerging market in general. So in last 10 years, anyways, given the growth prospects, the whole demographic profile, the fact that our per capita consumption is going up, so is our per capita income, India has historically traded at almost 77% kind of a premium to emerging market over last 10 years on average basis. Cut to where we are today, it's barely 88%, so it's not even a 10% deviation to what you have seen historically. I'm kind of just putting this data across because if you would have seen only the right chart of this presentation, you would have felt Indian market has become very expensive. But once I put this context to where we are trading on versus historical average, it doesn't look that expensive. So what does it mean? It basically just tells you that Indian market is performing backed by the earnings growth, which probably is the fact which is lacking for most of the other emerging markets. Another interesting data point. Now, this is again something which is very relevant because I'm sure you would have all heard that the climb of India from the relevance of economic growth in the world market. So just some data to put in front of you. Cut to CY 2000, which is the start of this century, India was ranked 13th among the top global nations when it comes to nominal GDP in dollar terms. Where we are today, if you cut to CY23, India has already reached the 5th rank. This is the 5th largest GDP or economic country when it comes to the economic contribution. What is even more pertinent, as per projections, and I think you would have heard that even at various forums, that India is projected to be the top 3 nation when it comes to the overall GDP contribution in a matter of next 3 to 4 years. So what does it tell you? It just simply shows you the climb, the march of India, which continues unabated. We keep delivering on a world stage. Then if you look at on the left hand side, the data which is relevant to look for you is, so though India is going to become probably the third largest economy in the world in a matter of next 3 to 4 years. If you look at exhibit 28, which I'm showing here, which is the right side of the chart at the bottom, India at this moment, even from a global market capitalization perspective, is the 5th largest market in the world from a listed equity space perspective. So we are already the 5th largest economy in the world. We are also the 5th largest market cap in the world, but we are ranked 8 when it comes to the Bloomberg World Index composition. To my mind, this shows that India is still underrepresented when it comes to India's representation is not fair, not fully reflected in the world scale on the world scale, and that gives me a lot of confidence that as and when we keep delivering on the promises which Indian economy holds, there would be huge opportunity for us to keep growing our stature globally, and we will gain a fair share of exposure and relevance. Going forward, this is another important point I think which is there on everyone's mind. We have all been talking about that, and this is now something which is imminent. So, come June 2024, we are expecting inclusion of India's bond index in your Bloomberg index and post in January 2025 in the JPM bond index. Now, why it is relevant from a perspective is if I just kind of throw some data to you and you can understand the magnitude of flows we're talking about. Uh, just by going the passive investment which will flow in, and I'm not even touching upon the active investment which will come in, we are expecting almost 20 to 25 billion dollar of flow which can come in by India's inclusion in bond index. Now, why is it relevant is once India's inclusion in the bond index happens, there are 2 3 factors which kind of comes into play for our advantage here. First is clearly if you look at, I'm sorry, let me just take you back. Yeah, sorry. So what I was highlighting is if you just look at the benefits of this inclusion in the bond index, clearly our cost of funds will go down because we are borrowing or we're getting money from foreign investments coming in. This will help in stabilizing India's currency because we are getting 20 $25 billion kind of flows incoming. It will also help in terms of reducing the impact of crowding out, which is happening at this moment. Because again, when it comes to domestic money, you have competition between both private and government to borrow that money to lead capex. But if incremental demand is also funded through the foreign inclusion in bond index and some money coming from there, we will have two alternate sources of money available to catapult India's capex story. And that is where the crowding out effect, which is happening now, will be eased out, which directionally means the cost of fund going down. So the inclusion is one important factor which we are all looking for. I like to just put a caveat here because clearly, I think one thing which has happened, and this is kind of just showing you how actively India's inclusion is tracked in the global market. In a matter of last 5 months, since November, when this inclusion was announced, we have already seen a tune of 10 to $11 billion of money which has already come in. This is all active money because clearly the inclusion has not happened yet. So over and above that, whenever the India's inclusion happened, there would be passive money, which again to an extent of 20 $25 billion. So you can clearly see the amount of enthusiasm which is there on the world scale of India's inclusion in the bond market, which will help us from economic flow perspective. Coming to liquidity, so we have talked about bond inclusion, we have talked about how market has been faring. I think a lot of us would agree that if you look at the kind of money which has been poured in Indian market, more specifically by domestic investors, it has something which has been stupendous to say the least. I'm just kind of putting some data in front of you. So if you look at what has happened in whole of last fiscal 24, India has seen cumulative $50 billion of money coming in with both DI and FI contributing. Now, if you just cut the chase and look at what kind of money is now being poured in by the domestic itself through either your mutual funds or other institution or insurances. So a very important data to look for is that in worst of the years, you have seen that FIs have pulled out anywhere between 15 to $20 billion of money out of India. And in the best of the years, you have seen a money of similar magnitude of about 20 $25 billion coming in. So then even if you dissect what happened last year, the contribution of domestic institutional investors was almost of a similar magnitude of FI, which basically means the relevance of now domestic money is getting more prominent. And this gives stability to market performance because clearly you are not talking about money which is more sticky when it comes to domestic money and not money which is a little more liquid, fluid. A lot of decision is taken by looking a call at the macro, but the domestic money is something which is more sticky and which gives you more stability when it comes to the performance of the market. So clearly, I think the liquidity continues, and that's clearly helping the Indian market at this moment. Over and above that, we have all seen how well the performance of small and mid cap has been. Just again going back to, so I think the most important data here is the bottom chart. Just look at it. The contribution of large cap in the overall India's market cap. If you scroll back to the start of the century, it was about 80-82% exposure of all the large cap come together from a market cap exposure perspective. Cut to today, we are looking at one of the lowest levels of 64% contribution of the entire market cap being contributed by large cap. What does it mean? The mid and the small, which used to represent barely 18% of the overall market exposure, that exposure has gone now and doubled to 36%. Now, this is something which is where I think a lot of active management skills, a lot of on-ground research, a lot of on-ground understanding and meeting the businesses, understanding the whole ecosystem comes into play. And clearly that is where an edge which we bring to the table as HSBC Mutual Fund. Moving ahead, I think that's something again which is on mind of everyone. Looking at where we are at valuation and what's the way ahead. So I think first of all, again, let me pacify any concerns on valuation. If you look at the left side of the chart, the market, if you look at again on last 10 years average basis, and this is Nifty PE return to valuation, it has traded on an average about 20 odd times on 1 year forward basis. Cut to where we were at the end of April 2024, we were again trading ballpark in that range. So first of all, on absolute basis, market was not expensive. It was just ballpark in range of what we have seen historically. Now, over and above that, superimpose one more data which I like to bring to your notice. If you look at the historical performance of Nifty or the Nifty 50 names, you have seen on average they have given you a earning growth of ranging between 10 to 12% if you take a 5 year, 7 year, 10 year CAGR on in journal. So just be with me and just do some maths along with us. If the Nifty has traded at about 20 times on 1 year forward basis, and it has delivered you on about 12 odd percent earnings CAGR. If I look at the PEG, which is nothing but the price to earning ratio divided by the underlying growth, you're looking at possibly 1.3, 1.4 PEG, which has been the historical range. Cut to where we are today, with multiples similar to what historical were at about 19.7, or for the sake of convenience, 20 itself. But the underlying earning growth has moved from 12% to almost 14 to 15% range. What does it mean is that the PG ratio, which historically has ranged between 1.3, 1.4, is now looking more like a 1.2, 1.3. So for every rupee which has been invested in market, you are getting more return than what you were getting earlier. It's a very important point to be kept in our mind that markets have not become expensive. And again, if you look at the right side chart, again, I have put it across. There are various segments and opportunities where the valuations are still comforting. Let me kind of make that data a little more visible to you. So again, if you look here, we have enumerated different sectors, what kind of multiples on average they have traded over last 10 years. To your surprise, market is not still in a zone where we don't find opportunities. You look at auto, you look at private banks, you look at PSU banks even after such strong rally which we have seen in last 1 year. NBFCs, you look at media as a place, you look at retail. So there are enough opportunities available in the market even today. So taking a very broad painted view or a broad brush view on the market that markets are expensive is not, but investing is clearly something which we don't believe in. When you dive in, you deep dive, you work on your portfolio construction strategy, you work on sectoral understanding. There are enough opportunities in our understanding which is in front of you, and which is also helping us to create a portfolio which helps us to tide through these uncertain times. Let me kind of take you through one portfolio construction strategy a little later. Just few more slides, and again these are top down slides, but again these helps to drive a point home which normally gets lost otherwise. This is the data which talks about what kind of overall Indian households asset or net worth is. So it's a number which is, as on March 23, reflects that Indian households have about $11 trillion of net worth, or the overall money which they have across different asset classes. Now, point which I want to highlight is if you look at property, it's almost half of that. So the real estate has always been one area where Indians have been investing, but that is a magnitude of 50%. Versus that, if you look at the direct equity exposure of the household which they have got in equities, it's barely 4.7%, which if you compare and contrast with property is 1/10 of that. Even when you look at something like an asset like a gold, which is more seen as an inflation hedge, there also your exposure is 1/3 of gold. The point is worth highlighting here is because if you look at the same number for developed economies, the range of asset ownership of households and equity range anywhere between mid to high teens, between 13, 15, 18% range. In India, we are at this moment only 4.7%. Just think about the magnitude, the scale, the opportunity it can create for us over the next few decades when we move towards that double digit and eventually high teens number of ownership of equity. We cannot conclude our top-down view without talking about what has happened or what is the expectation of the rainfall, because again, a lot of factors, right, from rural consumption to some amount of capex which happened, the cement consumption for independent houses, a lot of things depend, and also the biggest factor of inflation depends on rainfall. Good thing is if you go by again the India's IMD, the Met Department, it has called out that the expectation of this year's rainfall is 106%, which is again falling within above normal zone, because for forecast anything between a 5% plus minus deviation from 100 is called normal. Because it's projected to be 106, we are talking about broadly the average to above normal average rainfall, which should placate a lot of concerns which people have about the rural recovery. And again, if you kind of superimpose the recent commentary which you would have heard and which we have been getting from managements, a lot of them have started sounding uh, they're saying it's a little early, but they have started sounding about the opportunities which are visible in terms of rural recovery. And clearly, that could be one theme which can have its own role to play in the following year. More so if inflation, which is where it is now being at, has been pretty tamed. We have not seen a lot of concerns around that. And if we get normal monsoon, I think these two things can contribute positively toward the rural consumption story. So this was broadly what I want to touch upon when I talk about the market overall dynamics. Let me touch upon Flexi Fund because clearly I think this is the fund for all season. Uh, as you can see, different asset classes, different funds have different constraints ranging from the ownership which you have to have, whether 35%, 80%, 25%. Flexi, by definition, we all know is the only category where there are no concern whatsoever, no restriction when it comes to creating a portfolio either on your market cap classification, sectoral classification, style consideration factors. Everything is left to the to discretion of the fund manager, and that gives you the maximum amplitude of flexibility around that area. There are a few data points which I want to bring to your notice, and this is again, I'm kind of highlighting right now why Flexi as a strategy or a market or a more flexible opportunity is a far better product to own from a perspective of an individual. So what we have done here, we have taken return of four different indices: Nifty 50, which is for us in parlance is a large cap; Nifty mid cap; Nifty small cap; and Nifty 500. Mind you, for a Flexi, the benchmark is Nifty 500. Few important data points which are very relevant to highlight is, if you look at Nifty 500 has barely given you negative returns out of a stretch of this 18 years when we have studied this data for barely 3 years. Compared to this, even something like a large, mid or small have been more volatile where they have touched negative return for a period of 5 to 6 times versus a Nifty 500 is just given that negative return of 3 years. Over and above that, again, if you look at something which is more consistent performer as a bucket. So 95% of the time, if you see, it's been the bucket 2 or the bucket 3 where Nifty 500 is featured. So it's been either quartile 2 or a quartile 3 where the maximum time has been spent by Nifty 500 versus any other indices you take, it has been more volatile. So first of all, if volatility is something which we want to avoid, and clearly that's one aspect in which the risk get defined in the understanding of investors, then clearly Nifty 500 is a product which is the benchmark is a product which is lesser volatility which brings with it. Another important thing is, again, if you look at just not, so first is how you expose yourself to different market caps, large, middle, small. Second is how do you expose yourself to sectors. Now we have seen again some amount of sectoral theme which have kind of caught recent fancy. We have seen recent launches around that, as well as we have seen that there are few strategies which are more lopsided on either side of the strategies. Again, if you look at Flexi, and again in this data, what we're trying to present is if you look at last again this 18-17 year time window, there have been various point of time where different sectors have kind of performed well or have performed badly versus the broader market. So if you would have tilted your portfolio again to one specific sector, it would not have contributed positively. Again, a flexi approach is more sensible here, which gives you opportunity to evaluate on-ground situation and construct your portfolio. So market cap flexibility is great. The sectoral exposure is great. Last but not the least, from a perspective, again, style. So we all know there are various forms of styles in the market, from value to momentum to something which is more quality focused. Again, if you look at, there is no single style which has outperformed consistently. The point I'm trying to highlight here is clearly sticking to one, as they say, there is no single solution to all conditions in the market. And that is exactly what we're highlighting here. There is no single approach which is going to outperform over a longer period of time. Over a longer period of time, what you need is the flexibility at a fund manager level to create those bucket of outperformances by evaluating situation on ground. And that is exactly how the contribution has come in. Another important aspect which I want to bring to your notice is this is something which we talk about. So assume I have got a large cap focused ownership or a product. The problem there is some sectors like reality, chemical, cap goods, consumer services, something which has been more driven by India's consumer class, are not fairly represented within the large cap exposure. Similarly, if I go and look at within a mid cap exposure, something like a cap good has got very strong exposure, but something like a construction, even for that matter, IT services, has got lower exposure. Now, if I want to create a more diversified, well-rounded portfolio, which gives me a opportunity to play across sectors, across caps, then maybe a flexi cap strategy will help you because again, there you are not constrained to own only one specific market cap exposure. You are free to toggle between various market caps, and that gives a well diversification opportunity to you at a product level. This is very important data, very interesting data also. So what we're trying to highlight here is we're just highlighting that what kind of climb you have seen of Indian corporates To take you through, if you reflect back on December 2007, which is about 17 years back, if you look at the kind of a top company in terms of what kind of contribution they have had from a market cap perspective side, right? The largest company's market cap at that point of time was barely 4 lakh crores or 4.2 lakh crores to be precise. Cut to where we are today in 17 years, that biggest company, the largest company itself has grown some 5x. Forget about the smaller buckets where the growth of the magnitude is anywhere between 7 to 10x. So what we are highlighting here is clearly, even if you would have stayed in market, stayed invested, the best of the companies would have given you a return of at least 5x. And if you would have gone a little more flexible in your approach, you could have captured returns of anywhere with a magnitude of 5 to 10 times. So that's a very important data to bring to your notice, which just again highlights the fact that time in the market is most important as long as you stay invested. That another data in another form, I don't want to take much time on this slide, but just again something which is worth highlighting is in 2007 there were only 32 companies which were generating the profitability of 30 to more than 1000 crores. Cut to where we are today, that number has ballooned to 200, 7x growth. Similarly, 500 crore bucket, 5x growth. 250 crore bucket, 5x growth. So no matter how you cut, either in terms of profitability or in terms of market cap, the Indian market has generated such stupendous growth for all of us that just staying invested, being more flexible in fund construction would have been the best way to handle your overall exposure in the market. Let me just touch upon our exposure or how we kind of invest in the processes. So I'll take you through something where we take pride in. So first of all, if you look at, we cover almost 450 companies and the number is only increasing with each passing day. Now, why is this important is clearly, I think once you have a stock under coverage, you have a very informed view on that business. You would have created your own financial models. You would have been tracking that business for a while. And that helps you to form a more informed, constructive, and relevant view from a ownership perspective. Look at the data in front of you. There's almost 95% of the large cap stocks. So large cap, we all know, is stocks which are flying from 1 to 100, from 101 to 250 are mid caps, and 250 and onwards are small cap. From the exposure perspective, if you look at almost 95% of large cap, similar for mid cap, and 75% of small caps are the name which are covered by us, clearly making sure that fund manager is not at loss when it comes to getting exposure in the names. You have that ready universe available to you. So that's a very, very important aspect when it comes from a perspective. Again, that analysis more at the sectoral level rather than a top down. So you look at any bucket, it's touching 75-80% across buckets where we have our exposure, our coverage, which again gives us liberty to select, create a right portfolio more aligned to whatever the ground realities are. So that's very important aspect when it comes to as a investment house, that coverage is very important and an important factor for us. This is something which is more closer to me as an investment approach. So for me, I rely on my investment philosophy, which comes from 4 C's. Those 4 C's for me are company mode, corporate governance, cash flows, and comparative valuation. Let me not bore you with a lot of data here, but just to kind of highlight, whenever you are evaluating a business to invest in, the first factor which you look at, what is so unique about that business, which is the company mode. What are the traits which make that business worth owning? Is there is a technical way, financial benefit, lowest cost of production? Is it an innovator? Has it been the lowest cost producer? So those factors which makes a company stand out versus its peer within the sector is the first and the most important factor to evaluate, along with also the fact that what the industry is going to do. So I believe in one fact of life that you can find a good company even in sectors which are not doing well at this moment, and the vice versa, a not so good company even when the sector is in flavor or it's been doing well, because ultimately a lot depends on company's mode, and that you cannot ignore. Second important aspect, let's say once I have drilled down which company looks interesting to evaluate further, the governance aspects. That's most important aspect before which we drill down on the financials. Has the capital allocation decision making being right? Is there is enough flexibility in the hands of the professional management? Are related party transactions being completely checked? What are the policies? What kind of boards? What kind of committees you have? So all aspects on corporate governance is something which is very relevant and it completely cannot be ignored, and that's the most important factor when it comes to drilling down at a company level. Third is clearly cash flows. I think we have all heard about this, that though a lot of people talk about earnings, but I think earnings is more on accrual basis, or rather these are more accounting numbers, but cash flows are something which the business actually generates for itself and its shareholders. So we force a lot in terms of the cash flows of the business. What kind of capital allocation decision making the company is making? Is it incrementally contributing capital towards higher return profile businesses or higher return allocations? Has company been consistently been able to outdeliver or outsmart the cost of fund, which is again a good way of capital allocation decision making? So we evaluate businesses on cash flows rather than going by pure earnings. And lastly, the comparative valuation, because ultimately, as I showed you earlier, if let's say, the IT space or technology space, I have 15 names to evaluate, out of those, which company gives me the best opportunity of return based on the above three parameters, and at what valuation is it trading relative to its peers? These four C's, when they come together, they helps in creating a very strong understanding of what business to own, and that is how we even construct our portfolio from a bottom up perspective. Coming to the HSBC, I know I'm kind of aware of the time which we have. So let me just touch upon five important themes which we have used to construct our portfolio. And to be fair, as Ashish mentioned, you look at both my portfolios, whether it's ELSS or Flexi. These five themes you will find keep getting repeated. Again, the names can change within the sector, but ultimately these five themes are fairly represented across our portfolio ownership. So let me touch upon each theme at a go. First is formalization. We all have seen the benefit of the regulatory reforms, whether it's GST, demonetization, the whole financialization of savings, the Jan Dhan Aadhaar benefits. So whatever way and forms, the overall exposure of organized space is something which has been gaining prominence. You look at how the shift has been happening from unorganized to organized. You can clearly see various sectors, whether it's consumer durables, retail, real estate. Everywhere there is onslaught of the formalization, and that is one theme which is very very evident, because ultimately when the economy gets formalized, when a business gets formalized, I as an investor get more opportunity to have an exposure to it rather an informal sector, because that is where clearly I don't have a universe to play, and then that value creation opportunity is becoming more pronounced for me with the formalization benefits. That's one aspect which I want to touch upon. As I was talking about the whole benefit of data, Jandhan, Aadhaar, mobile, something all which have made our economy more inclusive, and that has again led to the benefit of formalization. This is second important theme. We all have been hearing about India's benefit on the demographic profile. What I'm trying to highlight here is, if you look at, as the passage of time will go on from 2019 to 2030, if you look at the maximum growth we are looking is at the top end of the consuming class, which is the elite consuming class, which has got an annual income of more than $25,000 per annum, or even the affluent one, which have got again an income ranging between $12,500 to $25,000. These two classes are growing at a magnitude of 2.3 and 2.1, while the rest others are growing more like 1.5. And the good part is, actually, from economy perspective, if you look at strugglers who are drawing annual compensation or annual income of less than $2,000 or 1875 to be precise, is actually growing slower than the rest of the peers. That is when we say that India's per capita purchasing power or per capita GDP is improving, which is at today reflecting $2,500, $2,700, is moving towards 4,000, 6,000, 8,000 eventually. And we have seen historically, as you move up the scale of your per capita GDP, your consumption pattern changes. You move away from sustenance based need to consumption based need. And that is where I believe the theme of consumption will have a strong tailwind in India to go. So that's second theme which we are focusing on. Another data point again which is highlighting, you just look at the pace at which the luxury consumption, because if you again go back, I've highlighted that the top two segments of affluent and the early affluence has been growing so fast, and that has led to the kind of consumption growth. So if you look at the left side of the data, we're talking about how the top 10% of urban consumer has been consuming versus the average consumption. So that number clearly shows you that the consumption is far higher in the higher end of the consumption basket, and which is what we are counting on. CapEx, we all know, I don't need to talk too much about it, but just look at the left side of the data, which is very important. We are highlighting that India, after a lull of almost a decade, so if you can practically call decade of 2010 to 2020 a lost decade when it comes to India's capital formation, where it plunged from all the way from 34.5% to the bottom of 27%. The overall capex strategy, which is either backed by PLI, which is either backed by the private capex, the government-led capex, defense strategies, whatever you talk about, that has now started to show you signs of recovery. From a bottom of 27% of gross fixed assets, capital formation net percentage of GDP is already clocked to 30%, 1 year about there. And we are very, very positive that given the current state of capacity utilization factor, the industries and the corporates are running short of capacity. There is so much of money which is deployed in either PLI or even capex. If you would have seen results of all engineering companies, that is in front of you. So clearly, that's another factor which we like. This is again some data which is showing you how well the acceleration is happening. PLI, as I touched upon, you can see the magnitude of money which is getting committed across the sectors. And lastly, I will like to just touch upon one more aspect, which is also a very important sector for us to focus upon, is the overall housing theme. We all have, and we saw that in one of the slides earlier, right? How much Indians love to invest in real estate. Almost 50% of our net worth is invested in real estate. So how can we not focus on that as a sector? Look at the exposure which we are talking about. Again, the theme which we are playing here is that not only the real estate consumption is going up, but the good part is again the benefit of formalization. The top 10, top 20 developers having a bigger market share, existence of RERA, a new regulator, which has given some amount of I would say reprieve to the buyers who would have otherwise been at the mercy of the developer. And the very fact, if you look at the middle data, that's very, very important in my mind. It talks about what kind of inventory days which we have. Again, historically, if you go by, a typical project would take anywhere between 30, 35, 36, 40 months or almost 3.5 years to construct a project. So whenever the system has an inventory of upwards of 25, 30 months, it means that the absorption is going slow. And that is when the power moves away from the developer's hand and it goes in the hands of the buyer from a profitability perspective. But if you cut to what we are seeing recently, and this is the data across 7 cities, Mumbai, Bangalore, Gurgaon, the number has already fallen below 20-25 months of inventory data. Now, the moment that data falls below 25 months, it basically means that uh, even if one wants to liquidate inventory in next 20, 24 months, the inventory will run out, but the new projects will still not come up for occupation. So clearly, that is the time when the power of investments go back in the hands of developer, and that is when real estate developer starts making money. The fact that we have seen this theme playing out, we also have a positive bias on this theme, and that is where our exposure is at this moment from a housing perspective. Also, is one sector which we really like. Quickly closing on the composition of the fund. So Flexi, as I've been talking about, you can see we are overweight on capital goods, real estate, automobile. There have been sectors where, again, if something like a financial services, banking, consumer durable, and mind you, this is most on the staple side where we are still seeing nascent signs of recovery. Although we have been incrementally evaluating how we want to have our exposure going forward, but as on date, this is another sector where we are marginally underweight. Just for your reflection, how the funds are positioned from a perspective of exclude exposures. I think what is more relevant is the active positioning. So you look at names like APA, Siemens, and these are named in front of you. These are fact sheet data, which is always there for you to look through. I think this is where I'll stop. Just the last slide to present, and then I'll hand it over to Ashish for any questions. If you look at when I've been highlighting that a flexi strategy is something which gives you abundance selection power at the fund in the hands of the fund manager. Today, if you look at the composition, we have about 60% exposure in the large cap, a well diversified, equally split exposure between mid and small, ranging between 18 to 20%, and still small marginal cash holding. If you compare this with either the benchmark, where NSE 500 will represent more like a 74-75% large cap exposure. So clearly, at a fund level or at a house level, we have identified opportunities which are below the radar of large cap. As I've been highlighting, there have been sectors where we find a lot of opportunities in front of us, and accordingly, we have created our fund. Uh, Typically, I like to run a fund which is more diversified. I don't take a very lopsided exposure in any of the sector. We like to have fair representation. And if you again look at from a perspective, as I highlighted, those 4C come into play as a guiding principle for me to invest in businesses.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.